Good evening, ladies and gentlemen. My name is Professor Barbara Casu, and I am Deputy Dean here at Mais Business School. I'm delighted to welcome you here tonight for the 2025 Mais Lecture. The Mais Lecture is one of the foremost events in the business and finance community here in the City of London. I am especially delighted to introduce Professor Isabel Schnabel, who will deliver the lecture this evening. However, before we begin, I would like to say a few words about the Mais Lecture. It was established in 1978 to honour Lord Mais, a former Lord Mayor of the City of London and Chancellor of the University. He played a key role in establishing the Centre for Banking Research here at BASE, and I am proud to be the director of the centre, which is hosting tonight's event. The centre is now part of the wider Faculty of Finance, one of the largest and most respected Faculty of Finance in the world. More importantly, it is also home to over 2,000 students, undergraduate and postgraduates, some of whom I see in the audience this evening. Welcome. Our academic and practitioner-focused research at BASE is thriving. We are ranked 4th in Europe and 32nd in the world for finance, according to the latest ranking of economics research. Over the years, we have welcomed a long list of acclaimed speakers, including governors of the Bank of England, several chancellors of the Exchequer, future prime ministers, a Nobel Prize winner, heads of the International Monetary Fund, the Federal Reserve, and the Bundesbank. Professor Schnabel is a worthy addition to this prestigious roll call. You will have the chance to ask questions after the lecture in a session chaired by my colleague, Professor Vaso Ioannidou. The Q&A session will be held under Chatham House rules. This means that what is said is off the record, so please do not attribute anything that is said during that session. And of course, we hope that you will stay on for drinks and a finger buffet. And so on to our speaker for this evening. Professor Schnabel is a member of the Executive Board of the European Central Bank, where she is responsible for markets, operations, and research and statistics. She's currently on leave from the University of Bonn, where she's been Professor of Financial Economics since 2015 and has served as member of the German Council of Economic Experts. Professor Schnabel describes herself as a passionate economist turned central banker. She is, she says, a convinced European. In many ways, then, working at the European Central Bank to keep prices stable across the euro area must be very close to her dream job. Since joining the ECB in 2020, Professor Schnabel has played a central role in shaping the bank's monetary policy, with particular responsibility for market operations. Professor Schnabel is widely recognized for her clear and thoughtful public communication and for her leadership in integrating climate considerations into central banking. She has also undertaken work on economic history, which, she suggests, helps her understand how the world can change quickly and in unforeseen ways. As the leader at a business school, I will listen with great interest to her thesis that promoting financial literacy improves individual well-being and the ability of central banks to keep inflation under control and maintain price stability. Ladies and gentlemen, will you please join me in welcoming Professor Isabel Schnabel to give the 2025 Mais Lecture.
Good evening. I hope you can hear me well, also in the rows and back. Excellent. Dear President Finkelstein, dear Dean Spicer, dear Deputy Dean Casu, and dear Professor Ioannidou, ladies and gentlemen. It is a great honor and pleasure to deliver this year's Mais Lecture, which has featured so many excellent speakers before me. It's a particular pleasure to be here today in London at a time when Europe is growing closer again. Today, I would like to speak about a topic that is dear to my heart and that has gained a lot of attention over recent years, which is the topic of financial literacy and its relevance for monetary policy. In fact, according to a recent survey, less than half of the people in the euro area know that the European Central Bank is responsible for maintaining price stability in the euro area, despite inflation continuing to be the most important issue for European citizens. So this is part of a broader societal phenomenon, the widespread lack of financial literacy. Financial literacy is the ability to understand and apply basic financial concepts. It empowers individuals to make informed financial choices, mitigate investment risks, and make provisions for old age. In my lecture today, I will argue that financial literacy also matters for the transmission of monetary policy. That is, how our decisions, for example, on changing interest rates, are transmitted to broader financial conditions and to the real economy, and ultimately to inflation. I will show that financially literate individuals react more strongly to interest rate changes, are more willing to take on risk, and are more forward-looking when forming inflation expectations. And together, these factors suggest that greater financial literacy tends to strengthen the transmission of central bank policies to the real economy. And therefore, it can make monetary policy more effective in achieving its objectives and lower the sacrifice ratio, that is the cost of reducing inflation in terms of lost output and higher unemployment. And for this reason, central banks, including the ECB, have increased their efforts to foster financial literacy. And such initiatives strengthen trust in central banks and support broader policy goals, including progress on the European Savings and Investment Union. In 2021, G20 finance ministers and central bank governors recognized financial literacy as an essential skill for empowering people and for supporting individual and societal well-being. It is defined as the ability to understand and effectively use basic financial concepts to take personal financial decisions. And such decisions are taken at various stages of life. People have to decide how much of their income they want to spend and to save, how to best invest their savings, how to finance big purchases like an apartment or a house, and how to make provisions for old age or emergencies. And this requires an understanding of how interest rates and inflation affect the return on various financial products and the cost of borrowing. The sharp economic fluctuations of the past few years have underscored how important financial literacy is for the well-being of households. The surge in inflation in the aftermath of the pandemic and the sharp rise in interest rates after a decade of low rates have highlighted the need for individuals to properly understand and react to changing inflation and interest rate environments. So, how can we measure financial literacy? Economists Anna Maria Lusardi and Olivia Mitchell developed the big three financial literacy questions, which assess basic financial knowledge and have become a widely used measure of financial literacy. So what are these questions? The first question is about the concept of compound interest. I will read it to you. Suppose you had 100 euros or 100 pounds in a savings account and the interest rate was 2% per year. After 5 years, how much do you think you would have in the account if you left the money to grow? And then you have 4 answers: more than 102, exactly 102, less than 102, or don't know. So I'm sure all of you got the answer correct. The second question deals with inflation. Imagine that the interest rate on your savings account was 1% per year and inflation was 2% per year. After 1 year, how much would you be able to buy with the money in this account? More than today, exactly the same, less than today, or don't know? And the third question is about portfolio diversification. Do you think the following statement is true or false? Buying shares in a single company usually provides a safer return than buying shares in a mutual fund. True, false, don't know. So, if you could answer all 3 questions correctly, and I think that's likely to be true for most people in this audience, you would usually be considered to be financially literate. Numerous surveys collect information about the level of financial literacy across various countries and socioeconomic groups. And the ECB has contributed to this effort by including questions on financial literacy in its Consumer Expectations Survey. And many of the charts that you're going to see today are from that survey. So these surveys show that many people struggle to answer all 3 questions correctly. As shown on this slide, in the euro area, less than half of respondents, around 48%, managed to get all 3 questions right. Moreover, financial literacy varies widely across socioeconomic groups. First, financial literacy is lower for younger people. Those aged below 50 display below average financial literacy, which could negatively affect their ability to build up long-term wealth or their decisions about major purchases. Second, women have on average significantly lower financial literacy than men. And this could lead to a higher risk of financial hardship and could explain why women are more often at risk of old age poverty. Third, financial literacy increases with educational attainment and income, potentially reinforcing inequality, as on average, financially literate people take better financial decisions. And finally, there is considerable variation across countries, also within the euro area. Financial literacy tends to be higher in Northern European countries. These differences have important implications for individuals, but they may also have an impact on the effectiveness of macroeconomic policies. And monetary policy is a case in point. The effectiveness of monetary policy relies on the smooth transmission of policy decisions, especially changes to key policy rates, to financing conditions, and from there to economic activity and inflation. Today, I will focus on 3 key channels through which financial literacy can influence the transmission of our monetary policy: the interest rate channel, the risk-taking channel, and the inflation expectations channel. In standard macroeconomic models, monetary policy works mainly through the interest rate channel. An increase in interest rates shifts intertemporal trade-offs in the direction of higher savings and less consumption due to a substitution effect. Higher interest rates dissuade firms from investing and households from purchasing houses or durable goods. Policymakers frequently use these models to derive policy prescriptions, thereby implicitly assuming that households react in an optimal way to changes in interest rates by adjusting their borrowing and saving. However, a lack of financial literacy in part of society could be one reason that not all people behave in the way that models with rational expectations assume. Consequently, policymakers may make mistakes in predicting household behavior, affecting the way monetary policy is transmitted to the real economy. For example, survey evidence suggests that financially literate households are more responsive to changes in interest rates. On the one hand, this reflects the fact that these households are more attentive to interest rate developments. Among financially literate households, 62% report paying some, much, or a great deal of attention to the level of interest rates. For households with low financial literacy, this share is only 49%. Please note that in the charts that I'm going to show, households with high financial literacy will always be shown in red, and those with low financial literacy will be shown in blue. On the other hand, a financially literate person has a better understanding of how interest rate changes will affect their financial situation and how they should best respond. The experience of recent years is a good example. In our consumer expectations survey, we ask whether people think that it is a good time to save or a good time to borrow. And when the ECB raised its policy rates in 2022 to fight inflation, shown in gray in the chart, financially literate individuals, these are the red lines, understood that this created more beneficial conditions for saving and less attractive conditions for borrowing, thereby strengthening policy transmission. By contrast, less financially literate people, the blue lines, reacted much less strongly to the dramatic change in the interest rate environment. In other cases, the impact on transmission is less clear. Households with high level of financial literacy preferred fixed rate loans when interest rates were low, that is before 2022, but less so when interest rates were high. This behavior tends to slow down policy transmission as fixed rate loans insulate these households from changes in the interest rate environment. By contrast, less financially literate households did not significantly adjust their preferences over fixed versus variable rate loans when interest rates increased sharply. The financial literacy of borrowers and depositors may also affect how swiftly and strongly banks pass through changes in policy rates to financing conditions. And this is a key step in monetary policy transmission. The more attentive households are to interest rates, the more likely they are to search for the best possible interest rate for both loans and deposits. And indeed, according to the Consumer Expectations Survey, financially literate households are more likely to shop around for the best terms of debt products, as you can see on the left-hand side of this slide. The same is true for deposits. During the recent hiking cycle, banks had to increase deposit rates to prevent a deposit flight as depositors shifted from low-yielding deposits to higher-yielding investments. And such behavior is likely linked to financial literacy. In fact, during the recent hiking cycle, cash accounts of corporates, which are managed by finance professionals, received higher interest rates for both overnight and term deposits than those of households, as you can see on the right-hand side, with corporates being shown in red and households in blue. Higher funding costs for banks then also translate into higher lending rates, strengthening the transmission of policy rates to financing conditions. A second important transmission channel of monetary policy operates through investors' risk appetite. This is called the risk-taking channel. Monetary policy influences people's willingness to take risks. Looser monetary policy is associated with greater risk-taking, as investors have an incentive to switch from safe assets to higher-yielding alternatives. Increased risk-taking, particularly through greater stock market participation, amplifies the aggregate effects of monetary policy adjustments. Research indicates that financial literacy plays a crucial role in determining the extent to which households engage in risk-taking by investing in the stock market or other risk assets. Financially literate households are much more likely to invest in stocks or mutual funds, as you can see in the chart on the left-hand side, thereby strengthening monetary policy transmission. Differences can also be found in the mortgage market, shown on the right-hand side. A higher share of financially literate households takes out mortgages and other loans than is the case for households with low financial literacy, although the difference is quantitatively much smaller than for stocks. Changes in aggregate consumption in response to interest rate adjustments are to a large extent driven by households with mortgages. Higher risk-taking may also affect monetary policy indirectly by mobilizing private capital for riskier and more productive investments. More risk capital should lead to higher productivity growth and hence a higher natural interest rate, or R star, giving central banks greater scope to stimulate the economy through lower interest rates due to a greater distance from the zero lower bound. The effects of high risk-taking can be self-reinforcing. If a larger share of the population rebalances their portfolios by switching from savings products or bonds to stocks in response to looser monetary policy, this may encourage firms to make additional investments. And the increase in investment leads to higher aggregate income, in turn leading to more investment in the stock market. Through this channel, stock market participation can magnify the investment response to monetary policy shocks. Wealth effects provide another amplifying channel, as looser monetary policy tends to go hand in hand with the better performance of riskier assets, increasing household wealth and fostering consumption with important distributional consequences. However, as shown over the recent tightening cycle, asset prices may also behave differently. Over this period, the dampening effect of higher rates on stock prices was more than offset by stronger risk sentiment, leading to a surge in stock prices. Such wealth effects weakened monetary policy transmission in the most recent hiking cycle. Lastly, financially literate households have been shown to be more likely to build up precautionary savings, making them better able to cope with financial shocks and smooth their consumption. This may slow monetary policy transmission, as these households can initially draw on their cash buffers when the cost of borrowing increases through policy tightening. Hence, the impact of financial literacy on risk-taking may also go in the opposite direction. A third key channel of monetary policy transmission is the inflation expectations channel. Since consumption and investment decisions, as well as price and wage setting processes, reflect expectations about the future pace of price changes, household inflation expectations shape inflation dynamics. A growing body of research suggests that consumers' expectations matter greatly for the transmission of monetary policy, possibly more than those of financial market participants. Research by the International Monetary Fund, illustrated on this slide, shows that over the recent inflation episode, near-term inflation expectations became an increasingly important driver of inflation in advanced economies. These are the blue bars in the left-hand side chart. In turn, factors that can reduce the sensitivity of inflation expectations to actual inflation developments can contribute to bringing inflation down more quickly. And the lower that sensitivity, the lower the sacrifice ratio, allowing for swift disinflation without causing high unemployment or a deep recession. It is therefore crucial that central banks understand how households form these expectations. Research shows that policy tightening has a stronger dampening effect on near-term inflation expectations and on inflation when a greater share of people in the economy are forward-looking. And this is what you can see on the right-hand side. Forward-looking households form their expectations on the basis of a broader set of information, including central bank policies and their expected impact on the economy, while backward-looking households base their expectations to a larger degree on past inflation experience. Therefore, a higher share of backward-looking households means that the central bank must tighten monetary policy more to achieve the same drop in inflation. The degree to which households are forward-looking likely depends on their level of financial literacy. Survey evidence indicates that households with higher financial literacy pay more attention to inflation. 52% of financially literate households pay much or a great deal of attention to inflation. This share stands at just 45% for the less financially literate, as you can see on the left-hand side chart. Higher attention also implies that these people are easier to reach through central bank communication. However, these data also suggest that even for financially literate people, almost 1/2 do not pay much attention to inflation. And this may explain why inflation perceptions of current inflation are often very persistent, adapting slowly to actual inflation dynamics. While headline inflation in the euro area dropped by almost 8 percentage points from its peak in October 2022 until the end of 2023, shown in yellow on the right-hand side, inflation perceptions fell by much less. Again, there's some difference of inflation perceptions across different levels of financial literacy. While the inflation perceptions of both groups were similar when inflation had reached its peak, those of financially literate people are now almost 2 percentage points lower than those of less financially literate people. Inflation expectations about future inflation paint a similar picture. The 1 year ahead inflation expectations of financially literate households have dropped much more quickly than those of less financially literate people, as shown on the left-hand side of this slide. These two findings about inflation perceptions and inflation expectations are linked and reflect the fact that individuals' inflation perceptions have a substantial impact on their expectations of future inflation. Overall, the share of consumers with inflation expectations broadly anchored around 2%, our target, meaning that 3-year inflation expectations are between 1.5% and 2.5%, has fluctuated around a level of only 17%, as shown in the right-hand side chart, indicating a low degree of anchoring of inflation expectations. Again, there are notable differences in inflation expectations linked to financial literacy. The share of consumers with medium-term inflation expectations anchored around 2% is significantly higher for financially literate households. However, these households have also been more responsive to actual inflation developments, with a share of consumers with medium-term inflation expectations around 2% declining more sharply when inflation surged and rising more strongly when it came down. The observed differences in the formation of inflation expectations translate into lower subjective forecast errors for financially literate people, as you can see on this slide. In other words, households with higher level of financial literacy tend to have more accurate inflation expectations. Financial literacy also affects household perceptions of real, that is inflation-adjusted incomes, with implications for monetary policy transmission. Over the past 3 years, real private consumption has increased more slowly than real disposable income. And this can be partly explained by households' misperceptions of their real income developments. 50% of households in the euro area experienced positive real income growth in 2024, as shown by the blue bar on the very left. By contrast, only 11% perceived that their real income had increased. This is the blue bar to the right. As shown on the right-hand side of this slide, the net percentage of pessimistic households is highest for the bottom half of the income distribution, and it is also higher for households with low financial literacy. This implies that lower inflation due to restrictive monetary policy generally had a weaker impact on consumption due to such misperceptions, dampening the recovery. The evidence presented explains why central banks have a keen interest in promoting financial literacy and improving financial knowledge. In our 2021 Monetary Policy Strategy Review, we acknowledged that communication to broader audiences is key for monetary policy. That is why we have put more emphasis on explaining our monetary policy decisions to the general public in an accessible way. Since President Lagarde took office, the Governing Council has made significant progress in making communication more accessible. For example, the introductory statement to the press conference after our monetary policy decisions has been replaced with the monetary policy statement, which offers a more concise and compelling narrative. And as you can see on the chart, this significantly reduced the textual complexity of monetary policy announcements, thereby increasing readability. To reach audiences beyond experts, the statement has been complemented by highly accessible, visualized statements available in all EU languages. When people understand how monetary policy works, they tend to trust central banks more. And people's trust in the central bank and in its ability to maintain price stability has been shown to help anchor inflation expectations and increase the share of forward-looking people in the economy. Knowledge about the ECB is linked to financial literacy. Financially literate households tend to be significantly more knowledgeable about the ECB, as illustrated on the left-hand side, and they are more likely to know the correct definition of inflation, as shown on the right-hand side. And this has implications for the ECB's credibility. In the most recent inflationary episode, the share of households with high financial literacy that trusted the ECB to maintain price stability over the next 3 years, again shown in red, rose notably after the ECB had embarked on its hiking cycle and inflation had come down significantly. By contrast, households with low financial literacy, in blue, lost confidence in the ECB's ability to maintain price stability as interest rates rose. Even when inflation had already come down significantly, the share of households that trusted the ECB's ability to maintain price stability remained low. And this is in line with recent evidence from the United States, where 60% of survey respondents believe that high interest rates cause high inflation. Therefore, to maintain and improve their credibility, central banks should help people understand their policy actions and their economic effects through communication and enhance their efforts to improve financial literacy. At the ECB, we are taking active steps to do this. We have expanded our communication efforts towards the general public by offering explainers on YouTube through our Espresso Economics channel, by speaking more frequently on TV, by engaging on social media, and by producing regular podcasts. Earlier this month, on International Women's Day, the ECB took another step in promoting financial literacy by committing to 5 joint actions with the national central banks, also aimed at closing the gender gap in financial literacy. And these include raising awareness, establishing a central bank financial literacy network, collaborating with national authorities for consumer protection, developing a harmonized financial literacy data set across Europe, and focusing communication efforts on key moments in life, such as early education, taking out a major loan, or building a pension. Of course, such efforts can only complement and not replace much broader efforts needed from governments and the education system. And it requires a long-term effort, with progress likely to be incremental. Financial literacy is also an important cornerstone of what is now called the Savings and Investment Union. Before it was called the Capital Markets Union, which is one of the European Commission's flagship projects. And under its first pillar, it aims to encourage citizens to invest in capital markets, which can contribute to financing part of the massive investments needed for the green and digital transitions. As I said before, financial literacy increases the willingness to make such investments, and therefore an improvement in financial literacy is seen as essential to achieve the stated objectives. And that is why the European Commission will adopt a financial literacy strategy in line with the ECB's efforts. So let me conclude. Financial literacy is an essential life skill that not only empowers individuals to make informed financial decisions, but can also make monetary policy more effective. Financially literate individuals respond more strongly to interest rate changes. They are more willing to take on risk, and they are more forward-looking when forming inflation expectations. And this tends to strengthen the transmission of central bank policies to the real economy. However, significant differences in financial literacy across socioeconomic groups highlight the need for continued educational initiatives. Fostering financial literacy can support policy effectiveness, enhance public trust in central banks, and help people make better financial decisions, ultimately contributing to a stronger economy and individual well-being. As Benjamin Franklin, who spent more than 16 years here in London, once said, "An investment in knowledge pays the best interest." Thank you very much for your attention.